If you've got money in an S&P 500 fund right now, there's a good chance it's one of these two, VOO or IVV. Most people pick one without a second thought, whichever their app shows them first. But they're not the same fund. Different company, different price, different dividend. So which one of them is a better deal? In this video, John invests $100,000 into both funds to see if the one you pick actually matters. He'll check every number people use to choose: fees, holdings, returns, income, and watch which ETF is better at each. And in the end, John will show us how both of these funds are projected to reach over $5.5 million, but one of them puts $25,000 more in John's portfolio. But before any of this can make sense, you have to see why this choice traps people in the first place. Here's why this is harder than it sounds. These aren't two random funds pulled from a list. They're the two biggest S&P 500 funds on the planet, and between them, they hold close to $2 trillion. At $100,000 isn't play money. For a lot of people, that's a house deposit. It's 10 years of savings. It's the kind of number you really don't want to get wrong. So John does what anyone would do. He goes hunting for the difference, some reason, any reason to pick one over the other, because two funds this big can't actually be the same, right? Well, let's meet them. The first one is VOO. That's Vanguard's S&P 500 fund, and it launched back in 2010. Today, it's the single biggest ETF in the entire world with almost $1 trillion sitting inside of it. When people say just buy the S&P 500, this is usually the one they mean. The other is IVV. That's the iShares version run by BlackRock, and it's actually the older of the two. It's been around since 2000. A little smaller, but we're still talking over $800 billion. A giant either way. And both of them are doing the exact same job. They're copying the S&P 500, the same 500 American companies, the same Apple, the same Nvidia, the same everything. That's the whole point of both funds. Match the index, hold what it holds. Now, here's where it gets a little strange. VOO isn't really its own separate fund, not fully. Vanguard has had one giant S&P 500 fund since the 1970s, the Vanguard 500 Index Fund. VOO is just a newer way to buy into it. Same stocks, same fund underneath. There's the old mutual fund version people have held for decades, and then there's VOO we're talking about, which is the ETF version of it. The difference is just how you buy it. The mutual fund version you buy once a day after the market closes. With VOO, you can buy it like a stock, right there, mid-afternoon, whenever. Imagine it like it's the same coffee, whether you grab it at the counter or the drive-thru. Different way to order, identical cup. So John is stuck choosing between VOO and IVV, and one of them is basically a side door into a fund that was already there. That's how close these funds are. So John starts checking the way you would. First up, the fee. And this one was never going to be a fight. They both charge 0.03%. That's $3 a year on every 10 grand you put in. For either one. Dead even. Move on. Then the holdings. And this is where it gets almost funny. Both funds hold the same 500 companies, same top 10 in the same order. Nvidia at the top, then Apple, then Microsoft, right on down the line with the weights matching to within a hair. The sector breakdown? Technology sits at 38.5% on one and 38.5% on the other. You could lay these two pie charts on top of each other and genuinely not tell them apart. So at this point, John's a little stuck. Every box he opens comes back even. So he pulls up the grade card, the independent one that scores these two side by side, category by category, and he runs down it. Momentum, even. Expenses, even. Risk, even. Then liquidity, even again. 4 categories, 4 straight ties. And then he finally sees it. One box, the only one on the whole card where the two don't line up. Dividends. IVV pulls an A while VOO gets an A-. It's a minuscule difference. John almost scrolls right past it, one little crack in a wall of matching grades. But a grade card is just somebody's opinion. John wants the real thing. He wants to see how these two have actually performed, and that's where this stops being boring. So John lines up the actual returns, real performance, head-to-head. He starts with last year. IVV is up 20.75%. VOO is up 20.37%. IVV wins. Barely, but it wins. He stretches it to 5 years. IVV again, 71.9% against VOO's 71.2%. 2 for 2. And John's starting to feel it now. Maybe IVV really is just a slightly better fund. Maybe this is the answer he's been hunting for the entire time. So he pulls the 10-year, the long game, the one that should finally settle it. And it flips. Over 10 years, VOO comes out ahead, 249.8% against IVV's 248.8%. Oh boy. So IVV won the 1 year and the 5 year, VOO won the 10 year. So far, every single number that's supposed to separate these two has either tied outright or flipped on us. And that's the whole story up to this point. But we still haven't run the real test. $100,000, 30 years, both funds side by side. So let's run it. We'll start with IVV, since it's the one that's been looking like the winner. Here's what IVV brings to the table going in. A dividend yield of 1.11%, dividend growth of 6.44% a year over the last decade, and share price appreciation running at 13.89% a year. Those three numbers are what drive everything that happens next. John puts $100,000 into IVV. Nothing added after that. After 1 year, it would sit at $115,000. 10 years in, it would reach $393,879. By year 20, it would climb to $1,493,869, and by year 30, IVV would land at $5,567,658. So by year 30, IVV would be paying John $478 a month, or around $5,741 a year. Now VOO. It has a dividend yield of 1.05%, dividend growth of 6.07% over the last decade, and share price appreciation of 13.95% a year. Look how close those numbers are to IVV, a few hundredths of a percent on yield and appreciation, a little wider on the dividend growth. And that gap is what nudges the final result. So John runs the exact same test, $100,000 in, nothing added afterwards. Watch each step. Year 1, $115,000, identical. Year 10, $393,986, basically the same. Year 20, $1,496,645, neck and neck the whole way down. And then at year 30, VOO would land at $5,594,555, slightly ahead of IVV's overall value. But around that time, VOO's monthly income would only be $397. Interesting, so let's line them up because they're not the same number. At year 30, VOO would finish at $5,594,555. IVV a hair behind at $5,567,658, a difference of $26,897. Then we flip it to income and it swaps. IVV would hand John $478 a month, while VOO hands John only $397 a month. That's $81 more a month for IVV, or about $972 more a year. One fund would end with a little more in the account, the other would pay a little more along the way. And there it is, the difference John's been hunting this entire time. Case closed, right? Pick your edge and go home. But let's stop a minute here and think about what this actually says. These two funds hold the same 500 companies, the same Apple, the same Microsoft, the same Nvidia. When Apple pays a dividend, both funds collect the identical cash. There's no world where IVV's Apple pays more than VOO's Apple. It's the same Apple. So where does that $81 a month come from? Look back at those opening numbers. IVV showed a higher yield and a faster dividend growth. VOO showed a touch more appreciation. But they own the same stocks, so none of these gaps are real differences in the funds themselves. The difference comes from two companies measuring the same dividends and the same prices over slightly different windows of time. That's the whole thing. Same money going in, slightly different math on the way out. That A versus A minus on the grade card? Same story. The crack was never really there. So the income gap isn't real, which leaves the big one, that $26,897 difference on the ending balance. And after all of this, you'd think at least that one has to mean something. Because after 30 years of compounding, tiny differences are supposed to explode into giant ones. So watch how it actually gets there. Of VOO's ending number, $5,419,136 would come from share price growth and $75,419 from dividends piling back in year after year. Now IVV. $5,380,983 from growth, $86,675 from reinvested dividends on that same $100,000 start. See what happened? VOO would edge ahead on price, while IVV would edge ahead on income. The two funds trade blows the whole way down, and after 30 years of it, VOO comes out slightly ahead by $26,897 in overall value. Now, what if you want income along with growth? Click the video on the screen and I'll show you the REITs that are projected to turn $100,000 into a $6 million portfolio that pays over $11,000 a month.